This video covers the analysis of revenue. You've already seen some revenue-related analysis with metrics such as Days Sales Outstanding. This video focuses primarily on revenue itself. Informally, we know that the term revenue refers to companies earning money from their customers. The FASB has a technical definition that matches that. Revenues are receiving assets or relieving liabilities as the result of the company's main business. For example, when Starbucks sells a cup of coffee, that's its main business and hence revenue. When Starbucks sells an old espresso machine, that is not revenue, but instead generates a gain or loss on the income statement. When Breville sells an espresso machine, that is revenue, because Breville is an appliance maker whose main business is making and selling things like espresso machines. When Breville sells coffee in its employee cafeteria, that is not revenue, but instead offsets their cost of running the cafeteria. The basic idea is that a company recognizes revenue when it's earned, and the amount of revenue is what the company expects to be paid. The Accounting Standards Codification for revenue gives the specific steps for revenue recognition and details on each step. Let's first look at an easy example, selling coffee for cash. The performance obligation is giving the coffee, and the price of the coffee is the price, so say $2.78. The reason for the weird price will become apparent in a few minutes. There's nothing to allocate because there is only one performance obligation, and we recognize revenue when Starbucks provides the coffee. Now suppose that someone pays with the app in the embedded Starbucks card. The performance obligation and the prices are the same, but the timing differs. When Starbucks receives money, say $30, it has not satisfied any performance obligations, but has a deferred revenue liability to the customer, which Starbucks calls a stored value liability. We can relatively easily allocate the price to the performance obligations because it is the price of the coffee. When Starbucks delivers a $2.78 cup of coffee, it has satisfied $2.78 worth of the performance obligations and accordingly recognizes $2.78 of revenue. But wait, it's not quite that easy. The app also has a rewards program. A free coffee costs 50 stars, and each dollar spent gives you 2 stars. This means that each $2.78 coffee gives you about 5.56 stars, or equivalently about 1/9 of a free coffee. In other words, Starbucks collects $25 for the first 9 coffees and gives the 10th for free, and the real price is $2.50 per coffee. And Starbucks puts the extra 28 cents into the deferred revenue. By the time the customer has bought 9 coffees, the deferred revenue from Stars has $2.50 in it. The 10th free coffee then consumes the deferred revenue. You might be asking yourself, can it really be that complicated? And the answer is yes. This excerpt from Starbucks Notes discusses how they defer gift card type revenue, including estimated non-redemptions, which retailers typically refer to as breakage. They also discuss how they record deferred revenue for the stars in the rewards program. In other words, even something as simple as a cup of coffee can have somewhat complex revenue recognition. Understanding sales growth is arguably the most important aspect of analyzing revenues. You can typically get relevant information on sales growth from a variety of sources, such as annual and quarterly reports, earnings announcements, conference call transcripts, and analyst reports. The information you get will depend on the company's revenue generation process. For example, in its annual report, Starbucks provides details on store openings and same-store sales, which are the major components of revenue growth for retailers. In a different industry, such as hotels, you will see different metrics, such as properties and revenue per available room. Deckers Brands discusses revenues in terms of its brands, channels, and geography. Having briefly looked at sales growth, let's see some examples of what is being netted from the net sales number that headlines the income statement. As required, Deckers reports sales net of expected returns, promotional allowances, and so on. If we dig through the notes to Deckers' financial statements, we find that it keeps a return liability for anticipated returns. For example, the $153,742,000 addition to the liability was deducted when computing 2021 sales. The recovery asset is an estimate of returned inventory, and the $39,939 was a reduction to the 2021 cost of goods sold. From this chart, we can see that Decker maintains fairly consistent reserves. If Decker under-reserved, we would see actual returns outstripping the additions to the liability, so that the liability would decline. A little more digging leads us to Decker's summary of allowances that are deducted from accounts receivable. Here we see the allowances for sales discounts and chargebacks, which are deducted when computing net sales. Decker's notes state that it includes the bad debt expense in the SG&A line on the income statement. The chargebacks are estimated price differences, markdowns, and corrections that wholesaler customers may deduct from their invoices. Similar to the returns liability, Decker's appears to maintain fairly consistent and adequate reserves. One potential concern is that the allowance for discounts is growing. On the one hand, this could simply reflect sales growth. On the other hand, it could mean that customers are demanding more discounts, which could indicate that Decker's will have to lower prices in the future. We can gauge the magnitude of the discounts and other adjustments by comparing them to gross sales. We compute gross sales by adding back the deductions. We can then compute the adjustments as a percentage of sales. Recall the potential concern about growing discounts. When we compare the discounts to the gross sales, we see that they're fairly close to prior years, and the increase in the allowance appears to be due to sales growth as opposed to pricing pressure. We also see that neither the discounts nor the chargebacks are very large relative to sales. The main adjustment is for sales returns, which show a dip in 2020 and is about 5.5% of sales in 2019 and 2021. The last thing I want to look at is how to infer cash collections from customers. The basic idea is that we can infer cash collections by adjusting the income statement sales number for the accruals reflected in deferred revenues and accounts receivable. We pull the adjustments from the cash flow statement because the balance sheet changes may reflect things like acquisitions that are unrelated to cash collections. This computation gives us an estimate of about $2.5 billion in cash collections. If we want to be more precise, recall that the net sales reflects adjustments for returns, discounts, and chargebacks. We also know that the receivables are reported net of allowances. The cash flow statement separately reports the bad debt expense, so the change in receivables line item reflects adjustments for discounts and chargebacks. Returning to our initial computation of $2.5 billion, when we look at the specific components of net sales and the change in accounts receivable, we see that our computation of $2.5 billion is actually collections less the estimated returns. When we appropriately adjust for the returns, we see that the collections were actually about 6% greater than our initial $2.5 billion estimate. In practice, the basic computation is often good enough. When you see something like Decker's large returns adjustment, then it may be worthwhile to make a more technically accurate estimate of collections. This completes the video on analyzing revenues. The best way to learn more is to take some time to look at the revenue-related disclosures and discussions for a company that interests you.